Welcome, everybody. I'm excited to be here with Richard Harris and my husband, Chad Reyes. We are grateful and happy that you were able to join us for this timely conversation. Just to share a little bit about Richard Harris, he assists highly successful families transfer assets on a discounted basis while providing estate liquidity without making taxable gifts in a transaction fully covered by and compliant with the IRS Treasury regulations. He has been serving some of the most prestigious family businesses since 1970. Now, Chad Reyes, for almost 20 years, continues to serve highly successful entrepreneurs, industry leaders, and generational families to protect and transfer wealth to future generations. As an understudy of Richard Harris, he is refining key tax-efficient strategies which are alternatives to grants and idiots. I'm Danielle Reyes. I'm co-founder and chief relationship officer of Wealth and Legacy Group, and I do not want to stand between you and this conversation. So I'm excited to hand it over to my husband, Chad.
Thank you, Danielle. So excited to be with you guys today. Today is such a timely conversation, as Danielle just said. You know, with 3 weeks away from our election, so many things moving. There's a lot that we're going to want to discuss today. Today's conversation is going to be broken up in two parts. Richard and I are going to spend about 30 minutes just having a conversation around some of the things that you received in that email. And then the remaining 30 minutes, we're going to be opening it up for questions and answers. During today's conversation, at any point, feel free to type in your question, and someone on our team will receive that question. And then at the end, after the 30 minutes of that conversation with Richard and I, at the end, we're going to be open up mics. We're hoping to get through as many of those questions as possible, but because we have a 1 hour period of time, we're going to try to be as efficient as possible so that we can effectively manage the time we have. So really tremendously excited to have you with us. As you know, we're in a very interesting time in the history of our nation. And one of the things that we're going to be talking about today is what are the possible outcomes regarding this election, and how does that impact your wealth? How does it impact the families, the generations of your wealth? So today I'm excited to have a friend of mine, a mentor of mine, and just a quality man that I've gotten to know over the years, who happens to be also the chair of Trust and Estates, which is probably the most prominent trust and estate publication. So Richard Harris is going to be with us, and he's going to be sharing a lot of his wisdom. Richard has over 50 years of experience in serving successful families. So we're just going to have a dialogue and a conversation. And Richard, I want to start the conversation with this question: is where do you see things going with the elections and the estate tax limits and everything that's happening right now in the world when it comes to the impact that successful families?
Well, first of all, my crystal ball is out for repair. It doesn't seem to be working properly. But apart from that, there are 5 possible outcomes to the election. And I'm just not talking about what will happen. I'm just talking about what can happen. 3 of them involve the Democrats controlling 1 or 2 of the 3 branches of government, in which case we don't expect to see any change currently. 1 involves the Republicans taking all 3 branches, in which case we will probably see some more tax reduction or other business-friendly tax acts. And finally, if the Democrats take all 3 seats, then we expect to see changes in the tax law that will affect mostly wealthy people. One of the changes that's been talked about a lot, it has to do with the estate and gift tax exemption, which is currently $11,580,000 per individual. The Democrats have talked about bringing that back down to $3.5 million. So that will greatly affect how things are going. One of the favorite strategies that's used very often in passing assets is something called a grantor retained annuity trust, a GRAT. and I'll go into more detail about it later, but it's possible that the Democrats will make a GRAT less user-friendly. And I'll describe what that means when I go into a description of the GRAT. So those are the possible outcomes. There is one other thing to note. If the Democrats take the presidency and the House, but do not take the Senate, they get another bite of the apple in 2022. And there are many more Republicans and Republican seats up for contest in 2022 than there are Democratic seats. So even if there isn't a change in the Senate in 2020, it's possible that it may take place again in 2022. So those are the possibilities that we see right now.
Yeah, Richard, I think as we look at families that are planning, and many of the families that we work with, we hear, do we transfer assets today? Do we hold assets? Do we wait to see what happens with the election? And what are some of the techniques that we should be thinking about? So I'd love to hear from you. Some of the techniques that we're sharing with clients, and a lot of them obviously are GRATs and IDGITs, but maybe you can go a little bit into that a little bit further. Probably most of the people that are on our call today have had some experience with one or two or maybe all of them. But just give a high-level overview so it'll give context for today's discussion.
All right. A GRAT is a technique that somebody puts an asset into a trust, and in return, they get an annuity based on the value of the asset. Now, what's happened as a result of COVID is unusually and probably never happen again, low interest rates. Now, these are creatures of interest rates. So with the low interest rate, for example, if you put something into a GRAT, the interest rate the hurdle rate that you have to exceed is 40 basis points, 0.4%. People are selling assets to trusts in exchange for a note. Now, depending on the terms of the note, the interest rate can be anywhere from 18/100% to 38/100% to 1.14%, depending on the length of the note.
Richard, can I just interrupt one moment? So I think it's important for everyone on the call to know that just 20 years ago, 2000, that those interest rates were, those AFR rates were 6%. And at that time, I remember people saying that, oh, we're in one of the lowest interest rate environments of all time. So, from just 20 years ago at 6% to a little bit over 1% 20 years later, that's substantial for families. And I know you're going to talk about it. I just wanted the people on the call to recognize the tremendous change in those rates.
Yeah. And the third technique that's used an awful lot to provide liquidity and to provide funds to help pay estate taxes is the purchase of life insurance in irrevocable trusts. Those are the three most common techniques that are used today. And I would suggest that if you're considering transferring business interests, that you get everything ready, that you have an appraisal ready to go, so that if you decide to pull the trigger this year, you have that piece already done and you can pull the trigger. I know all the attorneys that I've spoken to all have said they're incredibly busy already with these transactions, as are the appraisers doing these transactions. So if you're considering it, I would say take the steps necessary so that if you want to pull the trigger, you will be able to pull the trigger before the end of the year. In part because if the Democrats take control, they can put into effect the changes effective January 1 of 2021. So I would suggest that if you are considering any of that, you look at that now.
So, Richard, you were sharing about GRATs, IDGITs, and then irrevocable life insurance trusts. Can you kind of go a little bit further on that? I know how other reasons to own life insurance, and why and how does that play into obviously generational planning with these types of transactions that families put in place?
Well, other reasons, some of them have to do with families where some family members are in the business and other family members are not in the business. And sometimes life insurance is used to equalize or provide a fair amount to the non-family members in lieu of any business interests. Another thing that they're often used for is as a hedge. Many family offices, sophisticated family offices today, are using life insurance as an asset class to reduce the volatility of the portfolios that they manage. We're talking about the death benefit of life insurance, and as everybody understands, when you die has nothing whatsoever to do with what the state of the markets are, the state of the economy is, what interest rates are, or anything else. As one example, some people are using it. I know of one case where a family had liquidity to pay the estate taxes, and unfortunately, the estate tax, the person died in 2008, and their assets were all in securities, marketable securities, and they took a bath on the marketable securities because they had to sell them at an inopportune time. So having the insurance, even if you have liquidity, if you're planning to use other assets, is a backstop to prevent that. Finally, a lot of people are using insurance to provide a family legacy. And there's a technique that I've talked about called the family bank that accomplishes that for the family.
Yeah, Richard, I remember the conversation. We're at your country club, right? And I'm talking about all the times that we've used IDGITs or we've used GRATs with clients, and then you share with me this strategy of a GILIT, which is a grantor irrevocable life insurance trust. Could you just share a little bit about that, and then I'd love to also discuss further about a family bank and how family banks are utilized for estate planning purposes.
Well, as hopefully everybody knows, a bank has a charter, and a charter says what it can and can't do, and under what circumstances it can and can't do things. Well, a family bank also has a charter, although in this case, the charter is an instrument called the trust. Now, the trust can have features that, among other things, protect family members against creditors so that the creditors can't access money in the trust. It can protect against failed marriages in the future so that ex-spouses can't access money in the trust. If somebody's involved in a lawsuit, the litigators don't have access to the assets that are in the trust. If someone wants to reward people for making lifestyle choices that are not necessarily very remunerative, such as being a nurse, being a teacher, being a social worker, a family bank can be used to supplement their income and reward them for the lifestyle choice that they make. Additionally, a family bank can protect against beneficiaries who are profligate, beneficiaries who are substance abusers. It can restrict their access to any money in the family bank so that they can't act in a way that would be contrary to the wishes of the person that started the family bank. The bank can also make loans to family members. It can make loans for somebody starting a business. It can provide a mortgage. Additionally, it can act as an investment bank, and apart from making loans, it can actually invest in businesses. If somebody has a good idea for a business and the people in charge of the family bank, the trustees, and the parties involved, they can decide that they will fund that business. So you have all of those opportunities. And also, as we all know, access to healthcare is tremendously important. Access to education is tremendously important. And with the family bank, you can assure that all the beneficiaries of that family bank will have access to the best healthcare available and have access to whatever education they qualify for if it meets the requirements of the individual that set it up.
Yeah. Yeah, Richard, just before we continue, if there's anyone that's on the call and has some questions about anything that's been shared, you can put that in the chat, put your question in, and we're going to go to about 12:30, and about at 12:30, we're going to be opening up the line for those that have questions. But if you do have that question, type it in, and the reason why we're doing it that way is to make sure that we don't have duplicate questions from multiple people. So if you type your question in, hopefully we'll be able to get to that. So just, continuing with the conversation, Richard, so we're talking about idiots and grats, and part of what we had shared was beyond idiots and grats. But I think before we can talk about beyond idiots and grats, can we go a little bit deeper into idiots and grats and why right now they're being utilized? A lot of families are thinking about them, and quite frankly, I think some of the strategies that you and I have been talking about with families give them a little bit more ability to transfer wealth. But let's start with the idiots and the grats, and then we'll work our way to some of the other things we were discussing.
All right. In order to compare the different opportunities that are available for estate planning, one needs to understand how these particular instruments, these techniques work. GRAT, as I mentioned earlier, is what's called a grantor retained annuity trust. The grantor is the person that sets up the GRAT. They retain an annuity. And if whatever assets are in there, if they survive to the end of the GRAT and the assets have grown to more than what was needed to pay out the annuity payments, those assets can go to beneficiaries. The beneficiaries, the GRAT can be done in such a way that it's what's called a zeroed out GRAT, which means that the value of the remainder interest can be set at zero, so that based on the 40 basis points or 0.4%, the annuity payments are going to exhaust the amount put into the GRAT. However, if there's left over and it outperforms that 40 basis points, then there'll be money left and it'll go to the beneficiaries. The beneficiaries will get that money without any gifts. However, the GRAT doesn't lend itself if generation skipping is part of what you're trying to accomplish. In generation skipping, the full value of whatever that remainder interest is considered a gift at the time the GRAT terminates for generation skipping purposes. So you get no leverage with that. Additionally, if the individual dies during the term of the GRAT, basically the entire corpus of the amount in the GRAT will be subject to, will go back into the individual's estate and will be subject to whatever taxation occurs as a result of that individual dying. That's the GRAT. It is a statutory item. It was enacted by Congress and it is written into the Internal Revenue Code. So you do what it tells you to do and it's foolproof. The next item is where somebody is selling an asset to a trust in exchange for a note. And there is no precedent for this. There are no regulations. There are no specifics There are no laws that say that this technique is a viable technique. On the face of it, it should be a viable technique. It makes perfect sense. But the IRS can challenge these and has challenged where somebody is doing something that they think is pushing the envelope. The IRS will challenge it and say that the loan is a disguised gift. Even though there's a section of the Internal Revenue Code that says loans between related parties, and that's intrafamily loans, can be made at what are called the applicable federal rates, the rates that we talked about earlier. The IRS has taken the position that when selling an asset, there has to be a business purpose. There has to be, it has to resemble a business transaction. And so they want, many lawyers will say that we want you to gift 10% of the value of the asset into the trust to show that the note can be paid off. In addition, there are guarantees that can be made. As far as the payment of the note itself, it can either be an installment loan where the payments are made in installments, or it can be a balloon loan where interest is paid, and then at the end of the term, the full note is paid. Both of those require payments, as does the GRAT require payments. The sale to the grantor trust can be done in a generation skipping environment. So it has those particular advantages.
My phone is about to, for some reason, it's dying. I want to make sure that I don't get disconnected. So just continue. I'll be right back in 1 minute. Okay.
I'm using my computer audio, and it's very nice to talk to a map of something in the background there. There is a transaction that can be done with life insurance that involves no taxable gifts, does not involve generation skipping transfers, and has unique features that don't apply to other transactions. One of the things about a sale to a trust is that the terms of the loan need to be a reasonable amount of time so that it's probable that the loan will be paid off during the lifetime of the individual that sold it. Even though an older person like myself can get a 30-year mortgage, the IRS doesn't think that a 30-year term for a note that I have is a reasonable term considering my life expectancy. One of the things that the regulations allow for this particular transaction, which is a loan, is that the loan can be made for the life of the individual. So the loan is not paid off until the individual dies. Additionally, the loan treatment is guaranteed. Unlike the sale where the IRS may challenge it, there is a specific procedure in the code, in the regulations, that allows for the individual to guarantee that the IRS will respect this as a loan. Another feature of it is that interest can be accrued, so that in what's called a grantor trust, where for income tax purposes, the grantor is treated as the individual that owns the asset, but for estate tax purposes, it's not. The accruing of interest creates no tax implications. So the net effect is you have a transaction covered by regulations. You can make a lump sum loan, and the loan can be for life, and you can accrue interest. This is different from either the GRAT or the sale to the grantor trust. Mm-hmm. So if you're considering buying life insurance or already have life insurance and are paying premiums that stress your gift giving ability, either using up all of your annual exclusions and would like to use them for something else, or you're using some of your lifetime exemption. If you're doing that, one technique, if you already have that, is use up the rest of your exemption to fund the trust to pay future premiums. But rather than do that, even if it's existing insurance, you can still do the loan to fund the existing policies so that you take it out of the gift and estate tax arena.
Yeah. You know, Richard, I'd love for you to share a little bit more because a lot of the times when we're working with clients, I hear, well, why not use an IDGIT or an intentionally defective grantor trust, right? And I know you've kind of touched a little bit on it, but a lot of times attorneys default to that. You know, you and I do a lot of work with a lot of law firms, big law firms and accounting firms. Why do they traditionally default to that type of strategy? And I know that you had mentioned about the 10%, but why do you think they traditionally default to it? And one of the things you've always shared with me is you say, Chad, just because everyone's using it doesn't mean it's the most effective way of doing it. So I'd love for you to share a little bit about that, and then we'll jump into some questions.
Well, John Maynard Keynes, a famous economist, made a statement that said, the problem with new ideas is not implementing new ideas, it's giving up the old ones. And this is the attorney's playbook, and this is what they've done all along. And they know how it works, and they're not as familiar with the transaction that I'm talking about, even though it's covered by regulations. So they're not as quick to go to something that they don't know as they are to something that they do know, even if what they don't know might be more effective than what they do know. And I'd like to give you an example of how such a transaction can work and work to accomplish more than just the purchase of life insurance. Let's say somebody has a business interest, and let's say they, one of the things about any transaction with owners of businesses, and my clients are all similar to you, they're owners of closely held family businesses, you know, anywhere from 50 million up to $2 billion. And the key word for them is control. And they're loath to give up control. Well, there's a way of setting up your assets so that you don't give away control. You can have voting and non-voting stock. Even if it's an S corporation, you can have voting and non-voting stock. If your assets are real estate, they're probably already in LLCs, limited liability companies. You can have managers and non-managing members. And the non-managing members have no say in the conduct of the business, the same way the non-voting owners of stock do not have a say in the conduct of that business. So the individual can keep control of that. So let's say that somebody is wants to give away or wants to get out of their estate a $30 million piece of their business, and it's non-voting. And there's no marketability. It's a family business. Who is going to buy an interest in a family business where there's no control and it's controlled by other people? So appraisers come in, and generally the discounts that IRS is accepting are in the 30 to 35% range for those particular things. By the way, there's talk about the Democrats doing away with those discounts. So it's something very important to consider using right now. Let's say that to make life simple, the discount is 33 1/3%. So that the $30 million asset is now worth $20 million. And let's say the $30 million asset was putting out cash flow of 4% or $1,200,000. Somebody is buying a life insurance policy, and let's say the premium is $1 million a year. You know, it may be 50 million, 75 million, 100 million, whatever the number is. There, for whatever reason, they want to buy a very large life insurance policy. Well, they can make a loan of $21 million. And the loan is a lump sum loan, and it's for the life of the individuals, and interest accrues. So there's no gift taxes, there's no income tax consequences, no estate taxes, and no generation skipping taxes. With the $1 million, they pay the first year premium on the insurance policy. Now, they have $20 million left. Are they going to sit on $20 million or put it under their mattress? They're going to try to do something that's going to grow that $20 million or produce income. And by the way, hey, I have this business interest that just has been valued for $20 million. And it has cash flow that can pay for the insurance premiums. What if I sell that business interest to the trust for $20 million? Legitimate transaction. By the way, one of the things about the regulations say that the loan to purchase life insurance can be non-recourse as long as you make a representation that it's the intent that the loan is repaid, which means that it can be secured just by the death benefit, the cash surrender value, or both of an insurance policy, which means that it can be non-recourse to any other asset in that trust so that the other assets don't come into play in that trust. So that is specifically allowed. So you make a loan, it's secured by a life insurance policy. You make a representation to the IRS that it's the intent the loan will be repaid. And you have interest accrued, the loan is for the life of the insured. And if the individual is expected to live more than 9 years according to an IRS table, the interest rate is going to be 1.14%. And that interest rate is locked in forever. It will not change during the entire term of the loan. So you have a 1.14% hurdle rate. You're buying a large amount of life insurance that will more than cover the loan plus the accrued interest. And you've managed to get the business interest out of the estate into this trust without making any taxable gifts, which you would have to do with, which your attorney would recommend if you wanted to make a sale outright. You don't have to worry about the individual dying like you would in a GRAT if during the term, because that's not an issue. And you can have a generation skipping unlike what you have in a GRAT. So this covers a lot of bases. I know it's interesting. I know attorneys that will do a sale to a trust, a grantor trust, for the purpose of providing money to pay for life insurance premiums. And they'll want to use that 10% and all the rest of that, when instead they could be doing the transaction this way without any of the other issues that you'd have in the sale to the trust. So it's very advantageous if insurance is something that is being considered. If you already have the insurance, it can still be done to pay for the existing insurance. It's not a transaction where you require purchase of new insurance. So if you already have the insurance, you can use that as, in the trust, you can use that as a way to move assets out of your estate without any taxable gifts.
And Richard, I'd like to bring this up because I think this is an important thing. Obviously, at 1.14%, that's a low hurdle rate, right? But a lot of families, when we're sitting down and we're designing a wealth transfer plan, what I find is that when they're creating these plans, obviously they have to get some of this wealth out of the estate. The cash flow continues to grow and develop and increase. When it comes to this type of strategy, it gives you the ability to do that type of strategy, but all the additional. So let's say that asset is accruing a 7% return, and you have a hurdle rate of a little over 1. We'll keep on shifting now 6% of that asset every year, that money that's not coming back into the estate. So now it's substantially increasing the value of those assets that are outside the estate, and doesn't require us to have to get the additional money out of the estate as well. So maybe you want to just share a little bit about that. I know you've kind of touched on that pieces here and there.
All right. Well, there are a couple of things about it. One, in the installment sale, ultimately you're going to have to repay the loan. So generally what happens is that extra money that's being accrued or earned is being invested so that it'll be there to repay the loan when the loan comes due. With this transaction, the life insurance is going to repay the loan, so you don't have to do that. However, you're using the money, some of the money, or all of the money to pay for insurance premiums. So you're not accruing that. However, you can structure this transaction in a number of ways. For example, you can set up a policy, if it's a guaranteed policy, where you only have to pay 9 years and then you don't pay anymore. So if your premium is $1 million a year for 9 years and you're done, all that cash flow after the 9 years now stays in the trust and can be used for other purposes. Mm-hmm. So there are a lot of different ways of structuring the transaction to benefit the family. And all of these transactions and all of these things are done only with consultation with the family, and it's done with working with the other advisors, the attorney, the accountant, the money manager, if it's a family office, the people in the family office, working with them to structure something that will meet the goals. And people don't buy life insurance to have life insurance. People buy life insurance for what it does. And to the extent that somebody wants what life insurance does, this is something worth looking at.
Yep. Yeah. Well, thank you for that. Hold on one sec. We had an echo there. So I want to go back now and see if there are any questions. So Danielle, can we open up your line?
Hi. At this time, we don't have any questions, but we would like to encourage anybody that would like to share a question or even raise your hand to join in on the conversation.
Great. Yeah, well, I'll continue the conversation for a little bit longer, and if any questions or any hands get raised, feel free to just interject, Danielle. But Richard, so now we have obviously the end of the year. We have even some of the clients that I just recently was talking to you about one specific client of ours that we're working with, right? And I think your point that you brought up was so valid. Was a lot of these, if not almost all of these types of transactions to help shift wealth requires valuation discounts. I think, to your point, that getting the valuation discounts are so key at this very moment. And for many of the people that are on this call, they have some significant real estate, they have some significant business interests, they may even have some, interests in other partnerships that maybe aren't operating businesses. What would you say to that? I guess I know that you said get it done as soon as possible, but if they did want to pull the trigger, once those valuations are done, the transaction is much simpler to be able to accomplish some of the year-end planning. Correct?
Yeah, they need valuations to be done. I know of one appraiser that anticipates that, and they will give an indication if they can't get they can't get the appraisal done this year. They will give an indication of value this year that will be used, and they will finish the, and based on the information they have, they can come pretty close to what they think the value is going to be. And then do the rest of the appraisal the following year and get it done in the following year, but still have it happen. The other issue you have is with the attorneys in terms of having their time and as they get busy, having them available to be able to respond to your needs very quickly. So those are the two very important things. There's one other thing that I'd like to mention because it involves life insurance, but in a different fashion. One of the possible things that may come up is change in the capital gains tax rate. And of course, that change would probably bring that rate up higher. Now, for those people that have assets invested in securities, for example, marketable securities, or things like that, there is a way to shelter the earnings from income tax. There is something called private placement life insurance. And basically, that's where somebody is setting up a policy where the assets that are being invested in are assets that the individual would want them to be invested in. Because it's inside a life insurance policy, the growth of cash value in a life insurance policy is not subject to income tax. So you get away from that. You do have the cost of insurance. However, the cost of insurance in a well-structured policy, the total cost all in should be 1% or less, emphasis on the less, as your cost for doing that. So if you anticipate paying more than 1% of the value of a portfolio in taxes, there's a way to do that. And in some cases, you could even have the assets go in kind into the insurance policy. The thing is that you can't personally control the assets. You can have an asset allocator control it. You can have somebody in your family office control it. But you personally can't have the control of the investment. You can dictate asset allocations, where you'd like to see the money invested. The money can be invested also in non-traditional assets, private equity, hedge funds, things of that nature. So there's a lot of opportunity there to shelter other income that you may have apart from the income you're getting from the family business.
Thank you, Richard. We do have actually a few questions are coming in. The first one, I'm going to open up their line. Okay. Oh, David Fowler. David,
Hi, David.
It says that you're self-muted.
David, you have to unmute your mic.
Oh, sorry about that.
That's okay.
My question.
Hi, David.
Hi, how you guys doing? Thanks for doing this.
Our pleasure.
My question relates to the family bank. I mean, first of all, is it a company, and how are they directors or employees, members of the family? Is that how they get life insurance? I mean, health insurance? And also, how would you compensate? How would you compensate, like teachers, for example?
Well, this is, you're the person setting up the charter for the bank. In reality, it's a trust, and the people governing the family bank are the trustees of the trust. You can have what's called an administrative trustee in a tax-favored jurisdiction such as Alaska or South Dakota or Nevada. Matter of fact, people are using these things for, if they're in a state like I am or Chad is in New Jersey or New York where there's an income tax, you can take your investable assets and put them into one of these trusts in a state like Nevada or South Dakota, and it's not subject to the state income tax. But the point is that the individual, if you're the one setting up the trust, you're the one that makes the rules, and you're going to determine who the trustees are. Now, you have choice of institutional trustees. There are professional trustees that you can have, and you can have family members be trustees or have a say in the trust through various powers. And you can have it so that the family members can vote out and replace a trustee if the trustee isn't to their liking. So the trustee is the one that's actually following the instructions in the trust. In addition, you can give separate written instructions about what your intent is in setting up the trust. So when I was talking about health insurance, health, somebody doesn't have health insurance. Well, the trust can give them the money to purchase the health insurance. Somebody has something that isn't covered by health insurance. The trust can give them money to pay the expense that isn't covered by health insurance. You mentioned somebody's a teacher. Well, if you feel that that's a worthy profession and you would like to encourage that, but you want to make sure that they have access to more funds so that they can live in a lifestyle a little more comfortable than the lifestyle of a teacher, you can provide provisions in the trust to say that. And you can put limits on what it is and what it isn't that they would be able to get. So you're the person that is creating the trust. You're the one that is going to determine the terms of the trust. And it's going to be your wishes that are going to be respected by the trust. I hope that answered your question.
That makes sense. I really appreciate your help.
My pleasure. Thank you.
Okay, and we have our next question. Thank you, Dave. Our next question is Timothy Grow. I'm going to unmute. Timothy, just make sure on your end that you're not muted.
Guys, can you hear me?
Yes, we
Yeah.
can hear you. How are you?
Very good, sir. I'm concerned or having some concern. We're in the throes of executing a legacy trust or a grant, and council is concerned that we might not have it done by 1/1/21, whereas they feel that if we have a new president, the lifetime exemption would go down, et cetera, et cetera. Can this be done retroactively, whereas the trust we're trying to form could be declined or found to be fault?
What is the problem in forming the trust?
There is no problem in forming the trust. It's actually going to be included in a life insurance, an ILET type approach. But council is concerned that a new administration may find that this was done purposefully, which it is being done purposefully, and that the transfer of assets, let's just say again, like you indicated before, would be lowered to 3.5 million, that somehow the new administration may retroactively go back and say, you moved $11 million of net worth into and you did it. You did it just for the intended purpose, as it were.
Well, there has never, ever been a situation where an administration has gone back to a time when they weren't in power and take away things that were done while they weren't in power. I don't think constitutionally that can be done. So I don't see any problem in your using the 11.58 this year, as long as you get it done this year. As far as the insurance goes, if you're purchasing insurance, particularly if it's larger amounts, the underwriting process has to be expedited. It has to be in the hands of professionals that can get it done quickly, to get it done before the end of the year. However, if the insurance isn't in place before the end of the year, you can still set up the trust and still fund the trust before the end of the year to be able to pay for the insurance when it finally comes into existence. So there shouldn't be a problem with either of those things.
Very good. Thank you.
You're welcome.
You're welcome.
Good day.
Thank you, guys. Okay, right now we are good. If you guys just want to continue or close out, appreciate you all for participating.
Yep. Thank you. You know, Richard, I think we'll spend another couple of minutes and then we'll wrap up for today, unless anyone else has any specific questions. But I think a key takeaway, at least what I'm hearing, and this is the stuff that, you know, we're talking about, is one, make sure that if this is something that you want to get done, that you're being proactive on it, because there are a lot of moving pieces, especially when it comes to transferring wealth and getting valuations done and integrating in it. I think what I've seen, at least over the last 20 years, and I think you would agree over the last 50 years, is that when you bring in multiple parties, they have to be able to work well together to move faster. You know, our friend and mentor John Maxwell, he says this. He says, if you want to go fast, go alone. But if you want to go far, then go together. Right now, we need to go fast and far. So we need to figure out how to have the team work together to get this done.
Well, somebody needs to be a project manager, basically.
Yeah.
Whoever that is, whether it's the individual that's having it done or one of the professionals that's doing it that they trust will get it done in a timely manner. But you need a project manager.
Yeah. So yeah, so I think in recapping is that I think one is, you know, make sure that the team's working well together with, like you said, a project manager. Second is if they're considering grats or idiots and looking to do that by the end of the year, I think they should really highly consider utilizing a Gillet or an intergenerational split dollar type transaction. You know, one thing I realized, Richard, that we didn't talk about was that. Do you think it would be valuable for some of these families to maybe think about that?
It can be valuable. It's a transaction. It's a type of transaction that the IRS doesn't look favorably on, and will attack if they have the opportunity to do so. Basically, let's say you have 3 generations. I'm senior, my son is junior, and my grandson is the 3rd generation. I set up a life insurance trust that insures my son for the benefit of my grandson. And by the way, I say grandson because I don't have any granddaughters. Anybody wants to lend me a granddaughter, I'll be happy to include her. But apart from that, the question becomes and the loan isn't payable until the death of my son. And my son is 26 years younger than I am. And I'm not going to live as long as he is. What happens when I die? What's the value of the note? Well, here's a note that was issued at 1.14%. And my son's life expectancy when I die will maybe be another 20, 25 years. What would you pay for a note that's only payable at the death of the individual, is secured only by a life insurance policy? Interest is accrued, so you're not even getting interest. And the interest that's being accrued is at a 1.14% rate of return. There are transactions where people are buying the death benefit of life insurance. They're called life settlements. And they are a willing buyer in this scenario. If they go ahead and if they were doing a transaction and buying a policy, first of all, they want somebody with a life expectancy of less than 12 years or less, or 14 years or less. But the way they would value it is they're looking at a rate of return of anywhere between 14 and 16%. So they're going to discount the value of whatever it is, including the cash flow needed to keep it going, by that amount. Well, if you take a note to with the death of the individual and you use that kind of discount factor, you're going to come up with a very, very small value. Now, of course, the IRS doesn't like it, and they've challenged it. Some attorneys have taken I know one attorney that's been very successful and has taken a constitutional law approach to the whole thing, and has been successful in defeating the IRS. If you don't meet the IRS on that, if you have other techniques that you're also doing, the IRS is going to negotiate with you. I had one situation where we did this, the client did other transactions, and the IRS said, listen, we're going to look at all of them. We're not going to give you the discount that you asked, that the appraisal said, but if you accept a 15% discount on that, we'll give you all the other transactions, and we won't. Otherwise, you're going to have to go up to the next level and appeal it to, go up to the next level and deal at a higher level on this, and potentially wind up in tax court. And the clients decided that with the uncertainty and all of the costs involved, they accepted the 15% discount, which was still better than nothing. So they still achieved the discount, but that's the transaction. If anybody's considering it, I would be happy to talk to them and lay out all the details. Anything that I do, I want to show the pros and the cons, what can go wrong with any of these transactions, so that somebody is fully educated, has all the information necessary to make an intelligent decision. I'm not suggesting that you do it. I'm not suggesting that you not do it. If you want to, as to all of these transactions, I suggest that you have enough information to be able to make an informed, intelligent decision.
Yeah. Well, thank you, Richard. Appreciate you and your wisdom and your many years of doing this for hundreds and hundreds of families you've served. I think at this point I don't see any additional questions, and I want to be respectful of everyone's time. We promised we'd be done at 1 o'clock. So Danielle, if you want to just jump in, and we'll wrap up. But I appreciate everyone taking the time today and spending the past hour with us.
And thank you. My personal thanks for joining this, and hopefully I provided you with information that will be useful.
Yes, thank you, Richard, very much, and thank you, Chad. Again, my name is Danielle. We are grateful again and glad you were able to join us. If any of you would like the recording for today, or to be able to connect with Richard or Chad, please feel free to contact me. You all should have received an email from me, but my email address is Danielle@WLGprivateclient.com, or even dreyes@WLGprivateclient.com, just to make it simple. Okay, thank you guys, and hope you guys have a beautiful day.
Thank you guys. Have a great day.
Thanks very much. Bye.